Edward Glyn, you are head of global markets at Calastone. Thank you for joining us on BiTV.
Bonjour et enchanté de faire votre connaissance. On m'a dit que vous êtes un Français, donc je vais essayer de parler un peu de votre belle langue.
That's very kind of you, although we are publishing this interview on Business Imo Europe, so our listeners are all over Europe today.
That's very good for me. We'll carry on in English.
Great. According to the latest fund flow index that was published by Calastone recently, investors withdrew a net 121 million pounds from property funds last month, making August the worst month for outflows in the UK since October 2022. How do you explain this situation?
Well, thank you again for asking me to be with you today. I think it's probably a good idea to quickly kick off with where this data actually comes from. I think it makes it a little bit more meaningful. So Calastone, we are the world's largest global fund transaction network. And the particular data that we are discussing today is from our mainly UK-based business, where we have approximately 85% value by value and volume market share of all of the fund trading in the UK. But a lot of that flow is actually aggregated. So what we're talking today about is literally looking at in real time at the investment decisions of millions and millions of UK investors in real time. So it's really, if you like, the sentiments of a nation. And those sentiments that you just asked on in August with regards to 121 million pounds being redeemed from property funds. I think it's very important to say that in August, capital markets were very weak, certainly in the first half of August. So fear was a very big motivator for investors. Discouraging economic data in the UK showed that, I suppose, inflation has proven somewhat resistant to rate hikes. And even though the US economy has shown signs of accelerating in recent weeks, expectations of yet more rate hikes are very bad news for asset prices. So bond yields were pushed higher as a result, dragging stock markets and bond prices lower, and higher yields elsewhere, if you like, make property relatively less attractive and has put pressure on asset valuations. And this certainly had investors running for the safety, particularly of cash and money market funds and other cash instruments.
Okay, because from what I understand, maybe you can elaborate on that, but August was not an outlier month, as Calastone reports that year to date, investors have withdrawn 428 million pounds from their property fund holding. Have investors lost faith in real estate because of the current market environment that you just discussed?
So I like the figure that you just gave. I think what's perhaps even more interesting when we look at the trend is that I think since about autumn 2018, we've only seen 2 positive months in terms of property fund inflows. And property is really caught between the, I suppose we say in English, a rock and a hard place, the rock of a flatlining economy, which is negative for tenant demand, and the hard place of higher interest rates, both depressing asset values and competing for investor capital. And in July, I think we had the worst month for UK gilts since the mini budget. And the yield on UK government bonds for a risk-free return is now close to commercial property. And so investors now have to be sure of capital gains on property before they're going to take the plunge and accept the additional risk associated with this particular asset class. And we have to bear in mind that that this is a cyclical industry. Commercial property values have fallen significantly over the past year. Although we have seen recently perhaps more stability in prices, although it's very much unclear if this will hold as rates move up further. So rental values are a little bit on the up too, an indication of property's ability to act as an inflation hedge, at least over the longer term. But I suppose that paints a little picture for you that not just the past month has been poor, but the month before that, and actually all the way back to autumn 2018, where, as I said, we've only seen, I think, about 2 months of positive inflows into property funds.
Okay. Therefore, maybe the question that remains is, what will it take for investors to decide once again to allocate their capital towards real estate, do you think?
So escalating interest rates are punishing the property sector in 3 different ways. They're squeezing capital values, they're creating economic uncertainty, which certainly hits tenant demand. And they mean that bond fund and money markets offer now a more viable alternative to those who seek an income on their investments. Yeah. I think we've seen as well that foreign capital into property funds has been negatively affected for a number of years, whether that was due to the Brexit referendum, economic uncertainty, political uncertainty in the UK, geopolitical uncertainty as well. And therefore, we've also seen this, if you like, a crisis that we had a few years ago for open-ended retail estate, open-ended retail or real estate funds, which very much highlighted their vulnerability to sudden outflows. We know that property is illiquid, so meeting cash calls can be very difficult if redemptions are high. So all of these have created, if you like, this uncertainty. We know that property does offer the benefits of diversification, but going back to your question, until greater clarity emerges over the trajectory of both inflation, interest rates, and the wider economy, I think it seems probably fair to say that investors seem content to avoid the sector.
All right. Thank you very much, Edward Glyn, for this very valuable insight. It was a pleasure having you with us today on BiTV. Thank you all also for being with us, and we'll see you soon on BiTV.